Did the Federal Reserve prevent a worse Black Monday crash? Imagine a day when the stock market drops more than 20% in a single day. That was Black Monday, October 19, 1987. The Dow Jones Industrial Average fell about 22%, shocking investors worldwide. It was one of the biggest single-day declines in history. Many wondered if the crash could have been even worse. The answer lies in what the Federal Reserve did next. The Federal Reserve is the central bank of the United States, and its job is to keep the economy stable. After the crash, the Fed acted quickly to prevent a total financial disaster. They made sure banks had enough money to keep lending. They issued a public statement promising to supply liquidity whenever needed. This was a big deal because it reassured banks and investors that the financial system was not going to collapse. Behind the scenes, the Fed encouraged major banks to continue lending to securities firms, even though it was risky. This kept credit flowing and avoided a credit crunch that could have made the crash worse. The Fed also stepped into the Treasury securities market by injecting liquidity through reverse repurchase agreements. This helped keep the government bond market stable, which is essential for overall financial health. They lowered the federal funds rate from 7.5% to below 7%. Lower interest rates made borrowing cheaper and eased some of the financial stress. The Fed even supported the rescue of the largest options clearing firm in Chicago. This prevented a domino effect that could have triggered more chaos. Thanks to these actions, markets recovered quickly. Within just 2 days after Black Monday, the Dow had regained more than half of its losses. At the end of 1988, the market had fully recovered and even surpassed previous highs. Unlike the crash of 1929, Black Monday did not lead to a recession or widespread banking crisis. Many credit the Federal Reserve's swift response for preventing an even worse outcome. This event showed how important central bank intervention can be during times of extreme market stress. It also led to reforms like the introduction of circuit breakers on stock exchanges. These are temporary trading halts designed to prevent panic selling during sudden drops. So, did the Federal Reserve prevent a worse crash? Based on what happened next, the answer is yes. Their quick actions helped stabilize the markets, protect the economy, and avoid a total financial meltdown. This moment in history reminds us how powerful timely intervention can be in saving the day during turbulent times.